morning, everyone. My name is Joey Mouracadeh, Senior Investment Director here at Stanford Brown Private Wealth, and welcome to our inaugural Meet the Investor series. Joining me today from LA is Justin Miller, Product Specialist at Oaktree Capital Management, one of the largest alternative managers in the world. Good morning, Justin, or evening where you are. Thank you for joining us today.
Pleasure to be here.
Before we go into Oaktree itself, maybe you could give us a little rundown into your background and area of specialty and role at Oaktree.
Sure. So I work as a product specialist on Oaktree's global opportunity strategy. And with that strategy having $44 billion of assets under management, it's a wide purview. So my job is to help our clients and prospective clients understand what it is exactly we're doing in the portfolio, number one. And number two, what kind of deals we're seeing in the market today and how those deals might end up being into the portfolio. So again, $44 billion is a wide purview, a lot to talk about there. Previous to this role, I worked on the portfolio management side of a fund of hedge funds in Irvine, California, where my job was to manage our portfolio of hedge fund investments, as well as go out and source new hedge fund investments.
Great, thanks. And can you tell us a little bit about Oaktree, the firm you're at now, its origins maybe, and its specialty area on the investment side?
Sure. So Oaktree was started in 1995, but the origins go far further back than that. So, and the origins of the firm are actually very much tied to the origins of this investment strategy. So Bruce Karsh and Howard Marks got together in the late 80s as they became more and more interested in credit markets. You see, Howard Marks he's been investing for over 50 years. He started out on the equity side, but in the late 70s and early 80s, he began moving more over to the credit side as the birth of the high yield bond market really began to take off. So when he was on the equity side, he began to realize that, large cap equities were a highly efficient market, and it was really difficult to create alpha there. But this new thing called a high yield bond, there was a lot of inefficiency there. So he found that if you could do a lot of hard work underwriting high yield bonds, there were a lot of ways to create alpha. So he relocated from New York to Los Angeles, started following the high yield bond market, investing in it. And in 1988, he got together with a guy named Bruce Karsh, who was a lawyer by training. And they found that the market for distressed debt, so that is, high yield bonds of a company that is either in a state of restructuring or the market perceives could be going into a restructuring, that this market was incredibly inefficient, much more so than just high yield bonds. So Bruce Karsh had the idea of, hey, why don't we put together an institutional class fund to pursue an investment strategy centered on these distressed high yield bonds and leveraged loans. So that was the founding of the strategy. Fast forward to 1995, they were actually working at Trust Company of the West, and they wanted to spin out into their own firm. So that's when Oaktree was born in 1995 when they spun out. But the strategy again goes back all the way to 1988 and was really the foundation for them to found Oaktree later on.
You touched on a few investment terms there, so high yield bonds, distressed debt. Can you go into what they are and what that means specifically when you're investing in them?
Sure. So a high yield bond is a debt obligation of a company where a ratings agency has judged that that bond is a little bit riskier than, let's say, an investment grade bond. So an investment grade bond, it's highly, highly likely that the borrower through an investment grade bond is going to pay back principal and interest. High yield bonds, those are issued by, a little bit riskier companies. Maybe they, are newer companies. They don't have as long of a borrowing history. Maybe the amount of money they're bringing in relative to the money they have to pay out for interest payments is a little bit lower. So the market perceives them as slightly riskier. Now, distressed debt is a little bit different than that. With distressed debt, that's a situation where a company could be a high yield bond issuer, could be an investment grade issuer, but that company is either in a state of bankruptcy or the market believes that that company is approaching bankruptcy. So of course, if you're the owner of that bond, if the company goes into restructuring, it's probably not going to pay you back anymore. And at that point in time, you have to work through the arduous bankruptcy process. And after that process, maybe you get paid all your money back. Maybe you don't. Maybe you get equity in the newly reorganized company. Maybe you get something else. So because of that uncertainty, the bonds and loans of companies that are in bankruptcy or approaching bankruptcy are considered to be much riskier. So what does that mean for the price? You can trade, you can buy and sell these bonds, you can trade them. The price oftentimes falls as the market perceives that this company could be headed for a restructuring.
So with an investment grade bond that's effectively owning the debt of a high quality company, then you go into high yield bonds, which are the companies that maybe are a little bit riskier, as you mentioned. And then you move into distressed debt, which are companies that are in real trouble. In terms of the investment difference between high yield and distressed debt and what Oaktree might do or any investor might do if they're investing in these spaces, are you just buying the debt and hoping that things will turn out okay, whether it's high yield or distressed debt?
I think hope is a very interesting word to use there. So I would divide the universe into performing debt and non-performing debt. Performing debt is, you have every expectation in the world that the company is going to make good on its contractual interest and principal payments. There is a little bit of hope there, right? You buy that bond not thinking that the company is going to default. That's why back in the 80s, most people who bought bonds and loans, they really focused in on investment grade where there was much more certainty that the company was going to pay you back. When you get more into high yield bonds, you do begin to introduce a lot more of that hope aspect. I think what we're trying to do is a little different on the non-performing debt side. On the non-performing debt side, there is a very high possibility that the company might default, that the company might not pay you back. So at that point in time, the most important thing to do is to have a really strong understanding of the company's assets. Why? Because if you hold the debt of a company and that company goes through a restructuring, that debt has a claim on the company's residual value. So now all of a sudden, when you buy a defaulted bond or the bond of a company that looks like it might have to restructure, you're not so worried about the contractual coupon payment because it might not follow the contract at that point. What you are more interested in is the value of the company and the value of its assets, because now we're not talking about coupon, we're talking about the value of that claim on the residual value. So I think that's one of the biggest differences. It's, you no longer really have this hope that the company is going to pay you back. You're more focused on, okay, assuming this company doesn't pay me back, how much value is going to be left over for me? And is the price that this bond is being offered at in the market above or below that value? Of course, if it's far below that value, that's when the distressed debt investor wants to go out and buy a lot of those bonds.
So traditional debt investing is focused on the stronger expectation that you'll get your initial money back, and it's really about the coupon or that interest payment you get every year, right?
Right. And as that expectation goes down, you want to be compensated maybe with more coupon. So that's generally performing debt.
Yeah. And in non-performing, you're getting the coupon that might be, or the interest that might be higher, but you're also expecting some level of increase in what you paid for that debt. Is that right?
Yes, I think that's right. So when you get into non-performing credit land, what that really means is you need to have a higher prospective return because there's a little bit more uncertainty. If you let's say you buy a bond at par and it pays a 5% coupon. If the company pays you back, and when I say par, that's, buying the debt at 100 cents on the dollar. If the company pays you back at the end of the day, you made a 5% return. But let's say, the company's a little bit distressed and the price falls down. The price falls down because investors are demanding more payment for that commensurate more risk. So even though it's still paying you that 5% coupon, if you buy it at 90 cents on the dollar, 80 cents on the dollar, something like that, your return's going to be higher if the company pays you back, right? Because you're getting that, $5 for $5 coupon, even though you only spent $80 to buy the bond, if that makes sense. So yeah, you're always going to get you should get more return for more risk.
Okay. And in terms of the work that Oaktree might do in that non-performing company once they own the debt, Yes, there's a lot of research you highlighted in terms of analysing the company's balance sheet and working out what the true value of that debt may be. Is there anything that happens after they own the debt as well that Oaktree help with, and how do they help them effectively proceed through to non-bankruptcy and become successful again?
I mean, it really depends what happens with the company. So I think the key thing to remember is, as a lender and not an owner, you don't have as much influence over the company's management, right? Let's assume that rather than buying the company's debt, you buy the company's equity. Now you can vote proxy, you can call up the management team. If you get a big enough equity stake, maybe you can put someone on the board. You have a lot of levers to pull if you go in through the equity of a company that isn't in a restructuring. So on the debt side, if it's still a performing debt, if the company is still paying its interest payment, you can accumulate a large position, but you don't have a lot of influence. You start to get influence when the company begins to get a little desperate and when it thinks it might have to go into a restructuring. So let's say you own the entire debt tranche. So there's no one else who owns the debt. There's no other lender in that particular debt tranche other than you. As the company approaches a maturity, when it has to pay back your principal, it might begin negotiating with you because it might need to extend the terms of that bond or loan. And if you know the company well enough and okay, maybe just hit a rough patch, or you can negotiate additional coupon payment or something like that, maybe you'll extend the terms of the loan. So that's one lever you can pull. Beyond that, there isn't a lot that you can do until the company defaults on your debt. When that happens, then you do have a lot of levers that you can pull. So some of the things that we'll do at Oaktree is, number one, if we really understand the company and how it works, and we have a strong idea of how the company might go through a restructuring, we might accumulate a large portion of the company's debt. By getting a large portion, that means we can be very influential during the course of the company's bankruptcy. So that means, we can approve and deny certain things that are being debated in front of the judge. We can really put our finger on the scale in terms of what the company is going to look like when it emerges. And, depending on what type of debt we own, we might actually end up being in line to receive equity once the company emerges from bankruptcy. Because as you probably understand, if you're an equity holder of a company that goes through bankruptcy, that equity stake is normally wiped out, right? And the lenders end up taking over the company. So if we're in a big enough position and it's likely that we're going to be the post-reorg equity, we can do a lot of things like select a new management team, form the board, have a very big voice in terms of how much debt we wipe off the balance sheet, try and renegotiate some of the contracts that the company was engaged in. You can do that through a U.S. restructuring. So those are some of the levers we're pulling. They sound they might sound a little academic, but these are very big levers in terms of determining how well the company is going to do once it emerges from a restructuring. And if we're going to be a big equity holder, it's very important that we get this right.
Would that be termed loan to own type distressed debt investing, where you're expecting or hope, at some point through the process you might own the company and the equity of the company?
So loan to own is a strategy that some distressed debt investors will pursue. I don't think that's necessarily what we do at Oaktree. We go into a situation really agnostic to what's going to happen with the company at the end of the day, because, number one, that can be really difficult to forecast accurately. And number two, you don't really want to be perceived as this black hat investor who's going to come in and try and rip the keys away from the current management and owners. What we end up doing is we'll buy the discounted debt oftentimes of these companies, trying to create multiple ways to win. So, let's assume there's a company out there, it hits a rough patch, the market begins to, reassess the value of its debt, if you will, and it begins to believe that the company might be headed for a restructuring. So what's going to happen is the price of those bonds or loans are going to trade down. So let's say we buy the bond at 70 cents on the dollar. Generally, one of two things is going to happen. The company is going to do better and recover, or the company is not, or it could do worse and it's going to have to restructure. If it recovers, the price of our bond will probably trade back up to par. So if I buy something at 70 and it trades up in a couple of months back up to 100, that's a pretty good return. I'm pretty happy in that scenario. If the company doesn't improve, then it's going to go into the restructuring. And if we did our homework right, then we have the opportunity to own the company through the restructuring. That can be a very good return as well. Potentially, that could get us a much higher return because if you imagine the returns of buying debt, normally your return is capped at the contractual interest payment and then whatever discount you bought it at. But if you're exchanged in for equity, what we know about equity investing is that your upside is uncapped. So if we did a good job of underwriting the business, if we focused on buying the debt of a good company that just happened to have a bad balance sheets, that's when we can really produce really strong returns. We get that equity and it unlocks the upside potential. So, that's what we're generally trying to do. We're trying to create multiple ways to win where we don't necessarily need the company to go into a restructuring to make out well, but it does provide us a path to do pretty well.
Given that, there's a lot of sort of loose, high-level examples you've given there. Do you have any specific examples of the type of companies you may have done this sort of work on?
Yeah, so we're not only doing things in public markets where we buy and accumulate debt of companies with publicly traded debt. What we're also known for is doing so-called rescue loans. So a rescue loan might be a situation where the company is staring down the barrel of a restructuring. It's looking at the situation and it realizes it's running out of money and is probably going to have to declare Chapter 11 bankruptcy. But the company might have some unencumbered assets on its balance sheet, and it might have the ability to raise additional debt. So the example I'm going to talk about is a company by the name of Newstar. Newstar is an American midstream company, which means they own the pipelines and the refineries that take natural gas and oil from the wells, out in the middle of Texas or Oklahoma, and ship them to where they might be refined or put on boats to get to where they have to be. So, fairly good business, fairly understandable business. But if you remember back to April 2020, oil prices did a really interesting thing where the price of oil actually went negative for a little bit of time. Newstar was highly affected by by falling oil prices because, as you might imagine, if you're an upstream producer, you don't want to all of a sudden produce more oil so you can sell it at a negative price. So all of a sudden, the demand for Newstar's pipelines really fell through the floor, and they had an upcoming quarterly report that they had to do. So they needed to ensure that they had enough capital on hand, because not only did they have this quarterly call coming up, they had a near-term maturity that they were looking at. So they needed to raise capital and then go out to the market and say, okay, I know there's this maturity out there, but we have raised enough capital and we are in a safe place. If they hadn't have done that, they would have had to report for their quarterly report saying that there was a possibility that they might not be able to make due on the contractual principal payment. And what that means is that they would have to restructure. So we were able to work with the management team, underwrite the value of those midstream assets incredibly quickly. And this was in April 2020 when pretty much no one was getting on a plane to go anywhere. And we were able to come to a deal where we extended them a loan, 12% coupon, strong downside protection, as well as what we call call protection, where even if they recovered, they wouldn't be able to pay back our loan without paying some sort of penalty. So pretty good risk to put on the portfolio, especially when things were in a very weird spot. But if you remember back to April 2020, a lot of the publicly traded bonds and loans had already recovered in price after central banks had waded into the market. But because this company was very much in the energy space that had not begun to recover, it was really on the ropes and needed a helpful solution from an investor like us. So we were able to step up to the plate, extend them this 12% coupon loan, and make a very good return over the next about 6 months.
And you mentioned there strong downside protection on the way in. How did Oaktree get comfortable about that? Where did that downside protection come from?
With a company like this, it has a lot of assets, right? And unless you believe that the price of oil was going to remain negative for an extended period of time, there was going to be demand for this. Upstream producers were going to continue to produce, and they would need to get their crude oil, unrefined natural gas out to the market. So there was a very strong need for these assets. And if you looked at the value of the company, there was a lot to like. So even if the company ended up, defaulting in our debt a couple months down the line, we saw that there was a lot of value in these assets, and they really had a strong reason to exist. So that's how we really got comfortable with it. We worked with some of our partners in the energy space who knew the company well, were using their pipelines and had a strong sense of the demand for that type of asset out there. So that was partially how we got comfortable underwriting the value of this company's assets.
Well, it sounds like, in a situation like this, the way you've explained it, that there's very little risk to get that 12% type return plus recovery. How much competition do you have to come in and provide that capital? What gives Oaktree the edge in being able to do that? Is it, knowledge of the business or the industry, or how do you know, and how do you get that deal over someone else?
For Newstar, it was a very interesting time back then, and not only were a lot of lenders, not extending new loans because it was an incredibly uncertain time, but this was also energy. And we were one of the only lenders at that time that would extend credit to energy borrowers. So for us back then, there was almost no competition for a deal like that. Where we stand today when we're doing these rescue loans, and we are doing a lot of rescue loans today as companies are facing much higher interest expense, there is a little bit of competition. But I think what we can end up bringing to the table are a couple of things. First, we can offer the borrowers certainty of execution. Because we have a big strategy, again, $44 billion assets under management, and we're on a large platform. Oaktree has a total of about $183 billion assets under management. We can speak to an entire deal. So, we don't have to cobble together a group of other lenders to try and negotiate a deal with the borrower. Maybe there's a lot of back and forth. Okay, this lender doesn't like those terms. He wants to renegotiate it. If you're the borrower and you need to get something done very quickly, you're only negotiating with Oaktree. So that means we can offer you a lot of certainty of execution. The other thing we can give you is we can give you speed. We're experts on valuing the assets of distressed companies. We've been doing this for 35 years. We've been involved in hundreds of corporate restructurings. We get distress. So while it might take another lender months to get comfortable with the company, we can come in, underwrite the assets, develop an idea of how a restructuring might go down if the company is unable to service its debt, and we can get them that loan that they need very quickly. So, certainty of execution, speed, that's what we're really bringing to the table. And that's why lenders oftentimes want to work with us. And I think the other thing is, look, again, we're not the only lender doing this. We're not the only investment company that does this sort of thing, but we are regarded as a white hat investor. Again, if you ask me a question about loan to own, we're not always going into these situations with the idea that we need to take the company over. No, we like to create multiple ways to win. And the borrowers that we work with understand this. If they do well, we want to do well, and these loans are structured so that we will do well. But if they don't, we extended their option, we gave them the opportunity. They understand that that's when we're going to have to go in, take them to court, and take over the assets.
And you talking about rescue loans, you touched on the high interest rate generally being troubling a lot of companies into situations where they might need the rescue loans. Mm-hmm. Obviously, since even 2020, when you did that deal, interest rates, as everyone knows, have gone up considerably across the world. Do you see this being a ripe time for this type of investment, and what's your outlook around that?
We're not really all that well positioned to make a big macro call. We don't really think anyone is, and that's not a great way to create consistent returns over time. But we can see the hardship that a lot of companies are facing right now. If you consider that in the United States, the federal funds rate, so that that's the short-term interest rate, that was at 0% prior to the beginning of 2022. And since the global financial crisis, it was pretty close to zero. That meant lending conditions were incredibly easy for that 15-year period of time. And so any company that faced any sort of problem or wanted to go off and do a new business venture, it was very easy for them to raise debt capital. So what do you think that meant? Over those last 15 years, companies continued to put more and more and more debt on their balance sheets. But now that interest rates are much higher than what they were over the last 15 years, and many companies did not think that this was going to happen so quickly, many of those companies are facing a reckoning. They either have to grow into those new balance sheets by increasing their revenues, or they're going to have to restructure their balance sheets. So we are beginning to see a lot more companies face much harder financial conditions, and many of them may have to restructure. So I think it's best to think in terms of, imagine a company that issued floating rate debt. So not fixed rate debt like a mortgage in the US, but floating rate debt, where they're beginning to feel the pain of those higher interest rates today. What we're beginning to see is that some of the companies at the lower end of high yield, so these are companies that a ratings agency might say, they're not the safest, maybe we're going to give them a single B rating, something like that, that many of those companies should have an interest coverage ratio of less than 1 by the end of the year. Interest coverage ratio. What essentially that measures is if money coming in is less than money going out to service that debt, that's when your interest coverage ratio is less than 1. Now, that doesn't necessarily mean that you're going to have to face a restructuring immediately, but it means you're bleeding out money. And if held indefinitely, you will eventually restructure. So that's where we're seeing, a brewing opportunity taking place. And we are very excited about what we're going to see. Now, again, we're not going to predict the future, but if you just extrapolate from the pain that a lot of companies are feeling today and hold interest rates where they are for, a reasonable amount of time, we do think that there's going to be a lot of opportunities for us to work with.
Great. That sounds great. Listen, Justin, it's been a wonderful education into Oaktree and distressed debt investing. Thanks very much for joining us today, and thanks to all our listeners who've tuned in to listen to Oaktree and Justin. And I look forward to having you all join us next month for our next edition of Meet the Investor. Thank you.
Great. Thank you for having me.